Today, we will compare two big companies in the protein and packaged food industry, HORMEL Foods and Tyson Foods. To understand their strategies, we first need to look at the industry they work in. The global protein and packaged foods market is a major part of the world's food system. The processed meat market alone is expected to reach almost 950 billion by 2033. This growth is driven by people wanting quick, affordable, and high protein foods. But even with long term growth, 2025 has been tough. Companies are seeing slow sales growth, more price sensitive shoppers, and more people choosing fresh, healthier, and less processed foods. Because of this, companies must deal with both outside pressures like inflation, ingredient costs, and global economic trends, and internal factors like brand strength, efficiency, and innovation. Hormel and Tyson have to manage all of this to stay competitive. Looking forward, processed meat is expected to grow about 4 to 5% per year through 2033. Growth will come mostly from rising incomes in developing countries, strong demand for ready to eat and high protein products, and new ideas in packaging and sustainability. However, in North America, growth will be slower because more shoppers are choosing store brands and fresh options. Across the whole industry, five big forces shape performance: changing consumer habits, new technology and automation, global supply chains, higher expectations for sustainability, ongoing cost swings in feed, energy, and transportation. In this environment, Tyson and Hormel take different paths. Tyson is huge and vertically integrated, meaning it controls many parts of its supply chain. This gives it power but also makes it more exposed to cost changes. It is well positioned to meet global protein demand. Hormel focuses more on strong brands and value added products, items that offer convenience or premium quality. This gives it more stability and helps it grow through innovation and consumer trends. Now I will hand it over to Malcolm for key challenges.
Thank you so much for that wonderful introduction, Tanu. Obviously, we are comparing Tyson Foods and Hormel Foods, but they are not the only players in their industries, and they are facing rising competition. In regards for Tyson, again, I wanted to re-emphasize what Tanu was saying earlier, that it is one of the world's largest vertically integrated protein producers. That means it owns and operates a lot of its own supply chains. So it farms the animals, slaughters them, and then sends them to their own facilities. They have large, well-recognized brands like Jimmy Dean, Hillshire Farms, Ballpark, and then many more. Some of their challenges and their competition: JBS Foods, Cargill, Purdue, and obviously Hormel are all main competitors to Tyson. Some of their persistent challenges that we've seen is the rising price of protein and livestock, as well as the supply chain disruptions, since Tyson is particularly susceptible to any form of market movement. For Hormel, they're more focused on premium packaged products. So receiving a product, slapping their name on it, and then sending it out to consumers, which has its own benefits and disadvantages as well. Some of their main brands are Hormel, Spam, Skippy, as well as the recently acquired Applegate. Their main challenges in competition are Kraft Heinz, Conagra, General Mills, and they're much more susceptible to changes in the CPI, especially in the US, as well as the input cost. Since they're not able to control their own supply chains, they can suffer much more at the hands of disruptions from their suppliers.
Thank you, Malcolm. That was great. I'll now move into the key growth factors of Tyson and Hormel, but first, just a very quick recap of each company's historical timeline and growth trajectory. Tyson began in 1931 when John Tyson hauling chickens from Arkansas to nearby markets. By 1947, they incorporated formally and by 1963 they went public. A decade later, they rebranded as Tyson Foods with the logo we know and love today. In 2001, acquiring IBP pushed them into beef and pork, making them the largest U.S. protein supplier in the world. Then from 2014 to 2019, they expanded globally through major acquisitions like Hillshire and Keystone. And through all of this growth, they emphasized a core message, maintaining small town values despite large-scale operations. Hormel began back in 1891 in Minnesota and went public in 1928. Spam launched in 1937 and became a cultural staple. Starting in the 1980s, Hormel shifted from commodity meats to branded consumer products. From 2013 to 2021, they expanded with acquisitions like Skippy, Applegate, Justin's, and Planters. And by 2025, they launched the Transform and Modernize initiative to improve efficiency and cut costs. Over its whopping 130-year history, Hormel leans heavily on heritage and consumer trust. This slide reflects Tyson's evolution from being primarily a commodity protein supplier to a more efficiency-focused, brand-leveraged food company. The first driver is productivity. Tyson is investing in automation, facility consolidation, and restructuring operating expenses. The second driver is the shift towards prepared foods like Jimmy Dean and Ballpark, which carry materially higher margins than raw chicken and beef. And finally, Tyson is pushing into international markets, using exports and partnerships to capture protein demand growth globally, particularly in Asia and the Middle East. Hormel, on the other hand, is leaning heavily into premium and wellness adjacent food categories, areas where consumers pay more for quality, convenience, and perceived health value. Under the Transform and Modernize agenda, Hormel is driving structural efficiencies through automation, facility optimization, and smarter procurement, which is expected to deliver 100 to 150 million in operating uplift by 2025. At the same time, Hormel is aggressively expanding in both international regions and convenience-led distribution channels, positioning its brands where consumer demand is rising fast. Tyson and Hormel follow two very different growth paths. Tyson creates value through supply-side scale and operational efficiency, while Hormel creates value through brand equity and consumer-driven products. Ultimately, one company wins through production volume, the other through branding power. Tyson optimizes supply, while Hormel optimizes demand. I will now hand things over to Ryan to discuss Wall Street consensus and earning calls.
Thank you, Jacob. Now, onto Hormel. Hormel is the steadier, more predictable company in this comparison. Their business model is built around strong brands like Malcolm mentioned earlier, like Skippy, Applegate, Spam, which all give them reliable pricing power and higher margins. The financials in our analysis show that when the industry faced major shocks, Hormel maintained stable net earnings and preserved operating efficiency. Wall Street sees Hormel as a low-risk defensive stock. Analysts give it a hold rating, expecting modest appreciation but strong stability. Their Q3 2025 earnings reinforced that story. The demand was strong, organic sales were up 6%, and operating income held steady even though cost pressures hit margins. And overall, Hormel represents consistency, solid financial discipline, and long-term resilience. Now, with Tyson, it's a more larger, more complex business and that complexity comes with both opportunity and risk. Tyson controls huge parts of the beef, chicken, and pork supply chain, which means their revenue is much higher, but so is their exposure to commodity swings. In 2023, they posted losses, but in 2024, they rebounded sharply, showing how volatile the business can be. Wall Street is more optimistic on Tyson than Hormel in terms of upside. Analysis rated overweight with targets in the low 60s because of the recent momentum. The Q3 2025 earnings highlighted a real recovery, 13.9 billion in revenue, and EPS beat and raised guidance. But beef remains challenged, and Tyson is still dependent on external cost cycles. Tyson's story is a high reward, but also a high risk. Now, after comparing both companies through Wall Street expectations, earning calls, and financial metrics, we ultimately lean towards Hormel. Tyson's rebound is real and analysis see more short-term upside, but the volatility built into their business makes long-term performance harder to predict. Hormel, on the other hand, offers consistency. The margins are higher, the balance sheet is more conservative, and the results are less dependent on unpredictable commodity markets. Hormel nearly matched Tyson's net income despite being one-fifth the size, which speaks to the efficiency and stability. For long-term investors looking for reliability, Hormel is the clearer, safer choice. Tyson has more upside, but Hormel has a stronger long-term story. Now, I pass it on to Jonathan to talk about the business risk and compensation structure.
Thank you, Ryan. First, we're going to look at the shared industry risks. This consists of the volatility of commodities such as livestock, feed, and energy, as well as a sensitivity to supply chain disruptions, both on Tyson's end, where they own everything, and Hormel's, where they outsource their supply chain, as well as disease outbreaks infecting any animals, and as well as climate change. And with us moving into the modern age, cybersecurity concerns come into the picture, as well as labor shortages. All of these have direct impacts to both Tyson and Hormel on a large scale. Moving on to the Hormel risk profile, they are less volatile due to their very diverse product portfolio. As mentioned earlier, they have different meats, snacking products, global products, and premium products. So they have a lower dependence on the livestock commodity directly. They additionally have a strong hedging and cost management program, as mentioned earlier, the Technology and Modernization Initiative, which includes reinforcement of their strong supply chain to prevent challenges in the future. They're managing their portfolio complexity, investing in data and technology infrastructure, and enhancing their general operations and culture. Additionally, they also have a slight concentration risk as 16% of their revenue is gained through Walmart solely, but through that, they get very strong brand recognition. Moving on to Tyson, they do have a very high exposure to the beef, chicken, and pork cycles. This leads to high volatility as many outside factors, such as, again, mentioned earlier, disease, climate change, labor shortages, all of those have a very high correlation to the availability of that protein. And with the major acquisitions mentioned earlier as well, they do hold some higher goodwill risks during industry downturns, and they have an extreme sensitivity to labor and environmental liabilities, as mentioned, and they have some government concerns due to familial ties to high impact executive positions within the Tyson family. Moving to their business segmentation and performance drivers, Hormel has a very stable retail segment, and they're seeing high growth in premium prepared protein options. They also have a very high international profitability from their high margins. Tyson, on the other hand, they have beef, chicken, and pork as the main drivers, which are highly volatile, again, correlated to feed cost and everything of that nature. But those do come with high returns, and they are working on a strong prepared food segment, and they're also working on international expansions both currently and in the future. And moving on to the executive compensation structure and alignment, Hormel uses a pay for performance structure, which is tied to their EBIT, their EPS, and stock performance. This includes base salary, long-term incentive plans, and restricted stock units. They have a CEO pay ratio of 148-1, and their main focus is a strong retention alignment. They plan to keep people at Hormel for as long as possible. With Tyson, they have a high reliance on equity and deferred compensation. They have a far higher CEO pay ratio, 525-1. Pay for performance is far less consistent because of the industry's volatility, as mentioned earlier. And they have a change in control structure to protect their employees, where equity is fully vested if an executive is terminated within 24 months of a change in control.
All right, thanks, Jonathan. So in all the sections leading up to this, we've covered a lot of the qualitative and strategic factors of how these companies are different. And now a lot of those, a lot of the analysis is going to show up in the concrete metrics and numbers. First, taking a look at the income statement, the first thing that jumps out here is Tyson has nearly 5 times the sales of Hormel, at least top line. But what's remarkable is their net earnings or profitability is almost identical. And furthermore, we see Hormel's profitability is stable year over year between 2024 and 2023. demonstrating the robustness of their value-added approach, almost like a CPG or almost like a branded CPG company, whereas TYSON, more of their sales and their operations is driven commodity by the commodity meat markets and selling unbranded product. And you see just a lot thinner profitability margins and then also volatility in the earnings. So TYSON's earnings were negative in 2023 before making a remarkable turnaround to be almost equivalent to Hormel, but this just shows just how much more exposed TYSON is to exogenous shocks and the commodity markets compared to Hormel. And then this becomes even more clear when we normalize for based on using the profitability ratios. So Hormel's gross margin is almost 10 percentage points greater than TYSON's, so nearly 18% versus about 6%, 6.8%. And that again just demonstrates the robustness of value-added products like planters, spam, where they can command a premium, whereas TYSON, selling largely unbranded meat, has to compete on much thinner margins. And then moving on to the balance sheet, we see how their asset base further supports those strategies. Hormel is much more conservative. Total liabilities are only about 40% of their books, whereas TYSON is more heavily leveraged at 50%, a major risk factor given those volatile earnings and profitability that we looked at earlier. TYSON is much more asset heavy, as seen here with property, plant, and equipment making up about 27% of their total assets being tied up in that, since they have to own the slaughterhouses, the feed mills, and the trucks as a fundamental part of their operating structure. It's extremely capital intensive compared to Hormel. Hormel, meanwhile, is much more asset light. Nearly 50% of their assets are in what's called goodwill and intangibles. So again, just representing the value and trust that consumers have in their brands. Summing it all up, across the board, the key ratios just look a lot better for Hormel than for TYSON. The current ratio, for example, is much more, it looks a lot better. Hormel just paid off a nearly $1 billion in debt in 2024, signaling a very healthy liquid balance sheet. The debt to equity ratio looks a lot better for Hormel because they're not having to deal with a lot of that operational overhead that TYSON has to, providing a buffer against market downturns. For profitability, Hormel again dominates 10% versus 4.4 in the latest figures, and also much more stable, staying positive year over year versus TYSON having a negative year in 2023. The one area where TYSON edges out is asset turnover. That's because they have to churn through so much more volume to generate cash. And with that, I'll turn it over to our investor in conclusion.
Thank you so much. So if it wasn't clear enough already, we are choosing Hormel as a investment vehicle over TYSON for a variety of reasons that were already stated in this presentation. In terms of the investment timeline, we're saying invest now, especially with the 16% that Jonathan mentioned of Hormel SKUs ending up in Walmart, and Walmart beating expectations over the last few quarters, especially over other large retailers like Target. I think Hormel is going to see a large upswing in the coming quarters. As Ryan was talking about, the Wall Street Target share price was $26 to $28 as of December 3rd today. Hormel is currently trading at $23 a share, so it's an undervalued asset, especially being a dividend king without a 5% yield. We're saying buy as much as you can and hold it for a long time. In terms of lending, we would feel comfortable lending about 10% of the current liabilities on Hormel's books, or about $140 million at a 5-year term at 4.1%, which is relatively in line with most of their other corporate bond structures. And thank you so much for listening. We appreciate it.